Welcome back to our intermediate financial accounting class. Over the last few segments, we've been talking about the statement of cash flows, why it's important, how we build it, what FASB requires, what are the differences between US GAAP and IFRS. And then after we talked about a lot of conceptual stuff, we started jumping into an example of Avery arrowheads. And so far, we've got a check figure, our total change in cash. We've built our worksheets, and we've started to fill up our worksheets in step 3, going through our special transactions and figuring out the effects of those special transactions on our cash flows. And so far we've had 2 adjustments. We had cash paid for PP&E of $2,767,000, and then we had cash received from sale of stock for $1,050,000. And with that, we're ready to jump into our next calculation, which is purchasing $273,000 in marketable securities during the year. Now, our first question with all of these special transactions, is this operating, investing, or financing? And the answer is, I don't know, because the purchase of marketable securities, this means we bought stock in another company, depends. If it's trading securities, then it goes in operating. If they're available for sale or equity style securities, then they go in investing. So first thing I have to do in order to answer this question is decide, is this a trading securities portfolio or is it an available for sale or equity portfolio? And the only way to figure that out is to go to our balance sheet and look. We have 2 securities accounts in our asset sections. Up here we have securities available for sale, and down here we have investments in affiliated companies or equity method investments. From the information provided, I don't know whether this $273,000 goes into securities available for sale or whether it goes into equity method. But I do know that they're not trading. And since they're not trading, they must go in the investments section of our statement of cash flow, because the only time we put the purchase of stock into operating is if they're trading securities, and neither of these were trading portfolios. So at least I know where it goes on the statement of cash flows at this point. My cash flow effect is going to be a negative $273,000. The next thing I need to know is my balance sheet effect, and this is where things get tricky. I know I got a credit to cash. Is this an increase to available for sale or to my equity portfolio? And the only way you could really know this would be to dig back into your books or into your notes and find out, what did you buy? What portfolio is it in, etc. Unfortunately, we can't do that. We don't have a whole set of books or notes. So I'm just going to have to tell you at this point, these are available for sale securities. But again, it provides us a nice opportunity to say, you'd have to dig into your books to get the answer to this. So our balance sheet effect is going to be an increase to securities available for sale of $273,000. And again, now that I know the cash effect and the balance sheet effect, I can put it into my worksheet. So this is cash paid for marketable securities. That takes care of that special transaction. Let's take a look at the next special transaction from our notes. Equipment costing $500,000 was sold during the year for $59,000. The book value was $124,000. First things first, operating, investing, or financing. Well, the sale of PP&E is an investing activity. This is investing. And our cash effect is going to be for the money that we got. So it cost us $500,000. That's not cash. The book value is $124,000. That's not cash. It was sold for $59,000. That's our cash effect. And it's positive because we sold it for money, so we got cash coming in. Next thing we need to know are the balance sheet effects. And we know one of them right off the bat. If I sell off equipment, then I have to write off the book value. So my land building equipment account is going to decrease. Land building equipment is going to decrease by $500,000. I take the book value out of that account. But there's one more step to that journal entry. If I debit cash, credit land, I also have to get rid of the accumulated depreciation that's associated with this PP&E. So I'm also going to have a decrease to accumulated depreciation. Now I got to figure out how much. Well, let's see. If the face value is $500,000 and the book value is $124,000, the normal equation would be $500,000 minus accumulated depreciation gives me my book value. If I rearrange that, I can take the historical cost minus the book value, and that gives me the accumulated depreciation. So this is going to drop $376,000. And again, now that I know the cash and the balance sheet effects, I can put that cash effect into my worksheet. So I'm going to put it right over here. Cash received from sale of equipment. Cash is coming in this time, so we've got this positive $59,000. Our next transaction is the declaration of a cash dividend in the amount of $203,000. Again, first question, is it operating, investing, or financing? And this is actually kind of a trick question. The declaration of a dividend is none of those. It's only the payment of a dividend that's going to have a cash effect. Declaration just means I said I'm going to pay it someday, and then I give a date on when it's going to be paid, but that's not a cash flow. So this suggests there might be a cash effect, but it doesn't tell us if there is for sure or how much. All it says is you've declared a dividend. Now you got to figure out if you paid one. If you did pay it, it would go in financing because it's a payment to our owners. The only way to know if we actually paid out any cash for this dividend is to look at our balance sheet. We're looking specifically for a dividends payable account. If we don't have a dividends payable account, then I must have declared and paid this $203,000 during the same year because it didn't cause a dividends payable. If I do have a dividends payable account, then I need to look at the beginning and ending balance and what I put into the account to see if any payments were made. So let's take a look at our balance sheet, and I'm looking for dividends payable. So I'm looking down here in the current liabilities section, and sure enough, there's a dividend payable. It started at $60,000. It ended at $128,000, and that gives me the information I need to make my calculations. So I'm going to create a dividends payable account, and I'm going to give myself some room to work here. But I just looked at the account balances, and I know that it began at $60,000, and down here we'll put an underline, and we'll put in the ending balance. Again, I just saw it. It was $128,000. The other thing I know is that I declared a cash dividend of $203,000. So let's see. The declaration of a cash dividend would be a debit to dividends and a credit to dividends payable. I can put that number in there, and now I can solve for the amount that I paid out for the period. So if I take the $60,000 plus the $203,000 minus the $128,000, I get $135,000. That's what I paid in cash. Now, you probably remember this from way back when you first started doing T accounts, but when you do a plug figure like this, please always get in the habit of making sure that it actually balances out. So let's see, I'm going to do this, $60,000 plus $203,000 minus $135,000. And if that doesn't come out to $128,000, then I did my equation wrong. And that's so easy to do, especially if you're in a hurry, that it's always worth a second just to be sure. 128, I'm okay. The last thing I want to make a note of here, this is actually a negative number. I can't have a negative in a T account ever, 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 ever. Notice it's not a negative credit, it's a debit instead. But I need to make a note to myself that this is a negative cash flow so that I put it into my worksheets correctly. Now I know my cash effect, that's the 135. I also know the balance sheet effect because I did the T account for the balance sheet account. So I'm ready to put this into my worksheet. So in our financing section, I'm going to put cash paid as dividends. I'm going to make that a negative number. One quick aside here that I perhaps should have talked about earlier, we're using really formal titles for this example. Do you have to do it that way? No, it's up to you. I've chosen to use them because I think you need to see it this way at least once. Everything else we've done has been really loose and informal. But there is a formal way to say it. You could put cash paid for dividends, cash paid as dividends. There's some flexibility there, and that's okay. FASB's allowed it, but we do want it to look formal on a statement of cash flows. So we're not just looking at the change in dividends payable account. We're going to say this is cash paid as a dividend or for a dividend. That's probably long enough for this segment. When we come back, we'll continue on with our discussion, going through step 3 and building our statement of cash flows. We'll see you then. Thanks.